I just wish Mrs. B was around to see this today. I mean,
Yeah, how well it's done.
it just
mind-blowing.
For most individuals around the world, owning a home is a fantasy. This is why the middle class invest more in housing. Stock market investments are rarely made by the middle class. Why is real estate a lousy investment according to Warren Buffett? This is why. Practically, every person earning a middle-class salary in America, if not the entire world, owns real estate. Furthermore, the majority of those who own real estate do not do it outright. They instead borrow money to purchase it. This financial decision has a significant impact on their lives. The term house poor is used in the United States. This term refers to individuals who earn a decent living. They are forced to live in poverty since they owe the majority of their money to banks in the form of mortgage payments. Illiquidity. Illiquid investments are advantages since they may be liquidated quickly in a crisis. Take, for instance, equities and bonds. These investments have a ready market where they can be quickly converted to cash. Gold and silver investments, for example, are in the same boat. Real estate is most likely the single illiquid assets in the portfolios of middle-class investors. In every market, selling real estate is challenging. It's considerably more difficult during downturns, as sellers are frequently forced to wait 6 months to a year for cash in lieu of their property. As a result, having a large amount of one's portfolio in an asset class from which one cannot readily withdraw money is not recommended for the middle class. Opaque. In addition to being illiquid, the real estate market is also opaque. The listed and transaction values for stocks, bonds, and other securities are the same. In the case of real estate, however, the published prices range significantly from the rates at which transactions occur. A buyer's ability to determine the true purchase price is quite challenging. If buyers and sellers are not cautious, they can be taken advantage of by unscrupulous intermediaries. Cost of dealing. The cost of buying and selling real estate is likewise very high. To begin with, the government must be paid a big sum of money each time a sale is made. In addition, every real estate transaction involves charges such as legal fees, brokerage fees, and appraisal fees. As a result, approximately 10% of the value of each transaction is lost due to transaction expenses. This adds to the previously noted illiquidity. However, buyers are stuck with the property they bought, even if it turns out to be a mistake, because transaction costs are so expensive. Returns are low and costs are high. Low returns on real estate investments are well known. Real estate investments have historically yielded lower returns than inflation. The capital appreciation earned on real estate has just recently exploded. Additionally, the rental income is insignificant. Furthermore, earning rent necessitates a significant investment of time, money, and effort. Furthermore, renting out houses is frequently problematic. As a result, there is a risk involved. Despite the fact that many risks must be accepted, real estate returns are equivalent to risk-free investments. This is why real estate is a poor investment for middle-class people. Employability. Purchasing real estate requires a person to commit to a certain location. Real estate cannot be bought and sold frequently enough due to the transaction fees described above. The difficulty with settling in one place is that your options are drastically restricted. This is why millennials have decided against purchasing a home. House ownership is more of a liability than an asset in this era of layoffs and job shifts. Leveraged. Real estate purchases are frequently leveraged, as discussed above. This means that people pay interest on a significant portion of their income. All of these payments are based on the expectation of rising real estate prices. The issue is that if prices do not rise, investors will lose a substantial amount of money. It's important to realize that the price does not have to drop in order for the investors to lose money. Even if the price remains unchanged, investors have already lost a significant portion of their funds due to interest payments. There is no variety. Finally, because real estate takes up the majority of a middle-class person's pay, it takes up the majority of their investment portfolio. Rather than having a well-balanced portfolio that protects investors in the event of a downturn, the majority of middle-class savings are concentrated in the property market. This is why in 2008, when the housing market crashed, the entire economy collapsed. Why Warren Buffett REITs to real estate? Real estate is an unusual investment for Warren Buffett. Berkshire Hathaway, on the other hand, has recently invested in REITs. We look back at previous interviews and letters to see if we can figure out why he prefers REITs to private real estate. Warren Buffett is one of the few investors who has consistently compounded gains at a rate of 20% per year for over 50 years. The first reason is that there isn't a competitive advantage. Warren Buffett tells shareholders at a shareholder meeting decades ago that they are unprepared to compete with real estate investors. Warren Buffett had already invested millions in real estate and had enormous resources through Berkshire Hathaway, while Charlie had made his early fortune in real estate. Even back then, they believed they couldn't compete with REITs and other limited partnerships that specialized in real estate investing and had a competitive advantage in terms of knowledge. No competitive advantage. Many individual investors believe that they are well equipped to become real estate investors after watching a few YouTube videos and purchasing a real estate investing course from an internet guru. Most investors in actuality are overconfident in their talents. Warren Buffett is well aware of his limits and recognizes that investing in real estate is unlikely to yield positive results unless you are completely focused on it. There isn't enough mispricing in the market. You are unlikely to locate mispriced prospects if you are not fully committed to real estate, which is related to point number 1. Mispricings in real estate are unusual, according to Warren Buffett. Because most investors are long-term investors, the market is fairly efficient at pricing risk. Mispricings are more common in the stock market, however, because most investors are short-term focused and react quickly when their stock's value drops. Commercial real estate is selling at historically low cap rates at the moment, while housing is booming. Our ultra-low interest rate environment is reflected in the prices. Even back then, the REIT market was badly mispriced, and it continues to be so today. Many REITs, including blue-chip names like WP, Realty Income, and National Retail, have lost 20 to 30% of their value despite the fact that their underlying properties are more valuable than ever. Corporate tax disadvantage. Berkshire Hathaway is a corporation, hence corporate taxes apply to it. This, according to Charlie and Warren, puts them at a significant disadvantage in comparison to REITs, which are tax-free. If a property owns a 6% yield, the REIT keeps 6%, but Berkshire keeps a lower profit because of taxes. Even back then, Berkshire made REIT investments, which are more tax efficient because REITs only pay out 50% to 70% of their cash flow in dividends, with the balance being kept at the REIT level and not taxed. Furthermore, REITs have a higher growth and appreciation component than private real estate, resulting in lower corporate taxes. Management and scalability. Warren Buffett said in an interview during the Great Financial Crisis that if he could manage real estate more efficiently, he would buy single-family homes in droves. Many investors make the mistake of believing that real estate is a low-maintenance investment, when in fact, it may be rather labor-intensive. Tenants, toilets, and trash are the 3 T's you have to deal with. Is it possible for Warren Buffett to engage a property manager? He certainly has the ability to do so. In fact, if he did that, he would get a better deal than you or me. The problem with property management companies, however, is that their fees cut into your profits, and more crucially, their interests are not aligned with yours. Purchasing a home and giving over the keys to a property management is the same as purchasing an externally managed REIT, which we all know is rarely a smart choice owing to conflicts of interest. Warren Buffett benefits from competent management that is closely aligned with shareholders, and benefits from large economies of scale when he invests in traditional REITs. You can also deploy funds with just a few mouse clicks, making it simple to scale up your investments over time. Real estate investment trusts or REITs have a lot of potential. Warren Buffett has evolved into a value investor in recent years. He wants to purchase high-quality assets for a lower price than they are worth. However, as previously stated, the private real estate market is booming right now. Except in a few niche markets such as offices, malls, etc., you're unlikely to find bargains. Because of the ultra-low loan rates, demand for private real estate is higher than ever before. Even back then, many REITs were now trading at historically cheap prices, and Warren was purchasing them. Thanks for watching till the end. Do you think Warren Buffett is right? Tell me in the comment section below. Subscribe to the channel if you haven't yet and turn on the post notification for more.